Hello, and welcome to the first investment briefing of 2022, brought to you by Gemini Asset Management. Today we're going to talk about model performance and diversification, inflation, and sector rotations. First, let's tackle the topic that we've been getting most queries about recently, which is model performance and market performance. Chart 1 on screen now shows the performance of our Gemini GDP5 model, the relevant investment association mixed investment sector, and the FTSE All-Share over a 3-month period. Bear in mind, all charges are excluded from this chart to allow for a fair and direct comparison of the 3 investment instruments. As you can see, Gemini's Risk 5 portfolio has underperformed the FTSE All-Share by roughly 5% over the last 3 months and performed in line with the relevant IA mixed investment sector. This is over a very short time period, and Gemini's risk-rated portfolios aren't designed to meet a short-term goal, but they're instead designed to meet a client's investment goals over the longer time horizon. On screen now is Chart 2. Chart 2 shows the same instruments, again without charges for a fair comparison, but this time over a 5-year period, which Gemini would consider a far more suitable timeframe to judge whether or not the portfolios are potentially meeting a client's investment goals. As you can see in Chart 2, at times you can see the portfolio performing considerably different to the FTSE All-Share, most notably in the COVID-19 market crash, where the FTSE All-Share fell by more than 33%, the relevant IA mixed investment sector fell roughly by 20%, whilst the Gemini Risk 5 portfolio fell roughly 16%. Whilst there are times that our portfolios will lag a rampantly rising equity market, such as the FTSE All-Share in the last year, there are also important times when the portfolios should, and have, considerably outperformed. So the question is, why do the portfolios perform differently to the UK equity market? Whilst it's true that we invest in UK equity, and it's also true that we're overweight UK equity compared to our strategic asset allocation, we don't only invest in UK equity. Most of Gemini's portfolios, except those at the highest risk profiles, are made up of a variety of asset classes such as equities, bonds, and alternatives. And even in the highest risk portfolios, we invest in multiple equity regions, so that way we follow the principles of effective portfolio diversification. This means that more than one asset will drive the performance of the portfolios, and it will also mean that the performance of the models will be different to that of a pure equity index, such as the FTSE All-Share over the last 3 months. Using diversification, we aim to help you meet your medium and long-term goals by building portfolios that are typically able to protect on the downside and capture some of the upside in the markets. Diversification is essentially the same mantra as don't put all your eggs in one basket. And in theory, it may lower the volatility of returns generated while still meeting your investment goals. Chart 3 on screen now shows the performance of the various asset classes over the last 5 years. I know it looks a little bit busy, but each column basically ranks the different asset classes based on how well they performed that year. So in the 2017 column, you can see that Asian equities performed the best, whilst cash or the money market performed the worst. Gemini's GDP5 portfolio, shown by the red boxes, comes just under the FTSE All-Share and just above the US equity sector. In 2020, we see that the FTSE All-Share comes dead last, posting nearly a 10% loss during the year, but it's nearly the top of the list in 2021, after returning more than 18%. This shows that the FTSE All-Share has a high volatility of returns, and whilst it can shoot the lights out given the correct market conditions, it would be unsuitable to put all our eggs in one basket, specifically the FTSE All-Share basket, where most clients would be horrified at how volatile and inconsistent the returns from this may have been. To make it all a little bit easier to spot, we've overlaid a dotted white line on a chart which essentially tracks the position of the FTSE All-Share in the tables. The black line, however, tracks the position of the red boxes, which shows the Gemini GDP5 portfolio. You can see that the volatility and consistency of returns is completely different. Our portfolio is less volatile, and importantly, even though Gemini's portfolio is never at the top of the list, it's never even been in the bottom 3. So, in a nutshell, the reason why we've underperformed the equity index in the short term, but performed in line with the relevant mixed investment sector, has been due to our process of portfolio diversification, which, ideally, has dampened down volatility of the portfolio in the bad times, but should also allow us to capture a notable amount of upside in the good times. Let alone the fact that since the start of the pandemic, our Risk 5 portfolio has outperformed both the index and the sector. Now, just briefly, I'm going to touch on why the FTSE All-Share has done so incredibly well in recent months. Chart 4 on screen now shows the level of inflation in the US, UK, and the European Union. As you can see, inflation spiked in all regions after a prolonged period of relatively low inflationary numbers. This has led to policymakers rethinking their policies of incredibly low interest rates, high levels of quantitative easing, printing money, and high levels of government spending. The Bank of England has even already moved up the UK interest rate to 0.25%, and the major central banks around the world are all expected to raise rates further in 2022. This is distinctly different to the investment landscape we've experienced in previous years, where interest rates have remained exceptionally low, and in the most part since the credit crisis of 2008. So why does this matter so much to the investment returns of specific assets, like the FTSE All-Share? Well, in investment environments where interest rates are expected to climb, typically on the back of increasing expectations for inflation, some sectors do better than others. For example, more cyclical sectors such as financials, industrials, and energy tend to do well, whilst growthy sectors such as technology tend to do worse. So funds, portfolios, and indices which contained higher concentrations of these cyclical sectors, like the financials, industrials, and energy, outperformed considerably recently. Chart 5 on screen now shows the sector weights for each of the main equity indices in the UK, the US, Europe, and global emerging markets, which is denoted by the green bars with the acronym EM. As you can see, the UK equity index is made up from a large proportion of the sectors that are expected to do well in high inflationary environments, especially whilst interest rates are expected to rise. This is why the UK has done so well recently, and especially so against other national equity indices following the spikes of inflation. Still, as we mentioned before, timeframes are important, and it's worth noting that these cyclical sectors, financials and energy for example, were some of the hardest hit during the pandemic, and some of them still haven't fully recovered to their pre-pandemic levels. That's all from us here at Gemini for this month, and I hope that everything that we've discussed in today's video shed some sort of light as to why Gemini's portfolios underperformed the UK equity market in recent months, and why comparisons to a pure equity index aren't always suitable. All that's left to say is that we hope that you're staying safe, keeping well, and that we look forward to seeing you soon. Thank you.